Welcome back to another online video on macroeconomics. This particular macroeconomics video will cover the Federal Reserve and the goings on of our nation's central bank, and it's a follow-up video to money and banking that we introduced in the previous video. So just some historical background to begin. The nation's central bank, our Federal Reserve, was established in 1913 by the federal government, so it's actually an institution that is independent of the federal government, and we'll talk more about its independence in a slide or two, and the importance of the Federal Reserve Bank independence. And how does the Federal Reserve, what's the structure of our nation's central bank? Well, first of all, we have what's called the Board of Governors, and there are 7 members on the Board of Governors. There is the Fed Chair and the Fed Vice Chair. And then there are 5 other Board of Governors. So the 5 other, not the Fed Chair or the Vice Chair, are elected to 14-year terms, and they actually stagger every 2 years. So we have some consistency and some cohesiveness to the members of the Board of Governors. Now the Fed Chair and the Vice Chair, they are elected to 4-year terms. And the way this works is that the President of the United States chooses the Fed Chair, the Fed Vice Chair, and the Board of Governors, and they are then approved by Congress. Once they are approved, they are obviously appointed to their positions, right? So then, right now, our current Federal Reserve Chairman is Ben Bernanke. He's actually serving his 2nd term. He was elected as Fed Chair under George Bush in 2006 and served as Federal Reserve Chair until 2010. And he was reelected by Barack Obama and approved by Congress again in 2010 and will serve until 2014. So the Board of Governors gets direction from the FOMC, right, the Federal Open Markets Committee, which includes all of the Board of Governors plus 5 presidents of the 12 we call Federal Reserve banks, right? These are Federal Reserve regional banks. So they actually rotate the duty of serving on the FOMC. The 5 of the 12, so it's not the same 5. Actually, the Fed Chair from the President of the Bank of New York is actually always one of the members of the FOMC, right? So instead of having one bank in this very large, vast country, we have 12 regional banks which serve as our nation's central bank. So in each one of those, like I said before, has a president, which makes more sense because, if you think about the diversity and the size of our economy, we have agriculture, we have, mining, we have financial industry, we have manufacturing, we have, technology out in Silicon Valley. So in order to keep abreast of what's actually occurring across the entire country, it makes sense to have regional banks which sort of can keep a pulse on what's going on in their specific area of the country and report back to the the FOMC and to the Board of Governors. All right, so we have these 12 regional banks that serve as our central bank, as opposed to somewhere like Japan just has the Bank of Tokyo, which is the one bank, the central bank for Japan. And these are called quasi-public banks, and this is sort of a technicality, it's not really all that important, but might as well mention it. The banks within the district of a specific Federal Reserve Bank. So if we have a bank right here in Philadelphia, right, not too far actually from Pierce College. It's down on 6th and Vine is where our Federal Reserve Bank is, right? So all of the banks within the Federal Reserve District actually own that Federal Reserve Bank, but they don't have anything to do with policy, and they actually get paid a small dividend by the Federal Reserve for owning shares in the Federal Reserve Bank, but they have nothing to do with Federal Reserve policy, right? Now the Federal Reserve is the banker's bank. In other words, they're the lender of last resort. They serve very much the way you use a bank when you borrow and lend and you deposit and such. That's the same way that the Federal Reserve manages banks within its district, and we will explain in much more detail the roles or the duties of our nation's central bank. So here's a very good diagram of the way our central bank operates, as previously mentioned. Up top we have the Board of Governors, which again is 7 members, right? You have the 5 members who are elected to the 14-year terms, which stagger. Then you have the Vice Chair and the Chair, right, which served 4-year terms, all of which were appointed by the President of the United States and approved by Congress. Then you have the FOMC, right? So you have those 5 presidents from 12 of the regional banks. And within the FOMC, actually, there is a large contingent of the business community who's invited to come and deliver input or insight into what's going on with the economy. Right, so they meet throughout the year, monthly to sometimes for 1 day and sometimes for 2 days. So our, our, our nation's central bank operates with quite ease and efficiency through the system of the Board of Governors and the FOMC. Right? So you can see that within each of the 12 regional banks, you have commercial banks, which is the ones we're used to is things like Citizens Bank and Bank of America and Wells Fargo and Wachovia and those banks. All right, then you have thrift institutions, and some people may, be a member of a savings and loan or a mutual bank or the credit union. They're also under the jurisdiction of the Federal Reserve. All right, quickly here we see the 12 regional banks across the country, and obviously I'm not going to ask you all to memorize all 12 of these, but it's a little trivia. Maybe you're on Jeopardy sometimes. Say, can you name 5 of the 12 regional Federal Reserve banks? And like I said, we have one right here in Philadelphia. Okay, so like I said before, the FOMC, the Federal Opens Market Committee, they report back to the Board of Governors if you help us conduct monetary policy, right? And this idea of conducting open market operations. We'll examine the Fed tools in much more detail later on, but it's never too early to explain an important economic concepts. Open market operations refers to the buying and selling of bonds, typically government bonds, in order to influence the supply of money in the economy and therefore have an impact on the interest rates in the economy. So we say, okay, the FOMC sets Fed policy. Fed policy is conducted largely through open market operations, and again, it's the buying and selling of bonds, right? And again, down bottom here, just say, right, there's about 6,800 commercial banks and 8,700 thrifts that are all under the jurisdiction of the various 12 regional Federal Reserve banks. Okay, I talked about this before. It was established by Congress in 1913, right? The independent agency, and this is important, the idea that the Federal Reserve is free from or protected from the political process. And what we mean here is that the Federal Reserve members on the Board of Governors, those 7 members, and each of the presidents of the 12 regional banks, they are not up for re-election, right? So they were appointed by the president and approved by Congress, but they're not up for re-election. And this is an extremely important idea because sometimes the Fed will carry out monetary policy in a manner which isn't very popular with the public, but is vitally important to the economic well-being of our macroeconomy. One quick example of this, for instance, in the late 70s, inflation was staggering. It was getting out of control. The prime rate of interest was up near like 18%. So this was a killer for small and medium-sized businesses, even large businesses which had cash. It was stifling to have an interest rate so high. Unfortunately, at the same time, we also had very high unemployment. This was that stagflation period that we described earlier, caused by the oil supply shock. So the Federal Reserve took the very unpopular route of squeezing the nation's money supply. In other words, shrinking the nation's money supply, which actually increased interest rates even higher. Right, so the business community was up in arms. Individuals, living at that time were also up in arms because car loan rates and home mortgage rates were skyrocketing. But the Federal Reserve argued that if inflation could be curtailed, interest rates would then come down. And it took a while, but within a 3-year period, the prime rate had fallen from nearly 18% down to 9%. Right, so again, it was extremely unpopular. As a matter of fact, Paul Volcker, the Fed chair at the time, was receiving death threats from all kinds of people. We're kind of ashamed that it came to that, but again, the Fed took action which was unpopular but absolutely correct at the time. Okay, so what are the roles of the Federal Reserve? Some of these are rather mundane, but some of these functions are extremely important. The first one's simple, simply they issue currency. And if you see on any dollar bill, or it's a 1, 2, 5, 10, 20, 50, or my favorite, the $100 bill, your bill will have a letter on it, and that letter tells you which Federal Reserve Bank issued your currency. So they issue currency, and they actually take money out of circulation and destroy that. Right? It's kind of sad to destroy money. And you used to be able to get, unfortunately, the way the world works, you used to be able to get a tour of the Federal Reserve Bank, which I was lucky enough to have before 9/11, and now, obviously they're much more strict with who actually enters and leaves that building. But they used to give you a bag of shredded money, and I'm sure the person who worked there got sick of everyone saying, "Oh man, it's a shame you didn't give me this money before you shredded it." All right, so the second function of the Federal Reserve is setting the reserve requirement. And this one is vitally important. We're going to spend a lot of time on this, right? So every day, people like you and I go into banks and we deposit money. Of course, small, medium-sized, large businesses deposit money, nonprofits deposit money, right? So within those checking accounts, there is a required reserve. And right now, currently in the United States, the reserve requirement is 10%. So if I were to go into my bank today and deposit $1,000, right? By law, that bank, we'll say call it Bank ABC. Bank ABC needs to hold $100 or 10% of my $1,000 deposit on reserve. Now they can either keep that in their bank vault or on reserve with the Fed, and they typically keep it on reserve with the Fed, right? And the bank, ABC Bank, can then lend out the rest of that deposit, the rest of that money, right? So the Fed sets the reserve requirement, and that is right now, currently in the United States, the reserve requirement is 10%, right? It was actually, it was either 1992 or 1991, I can't remember exactly, but the reserve requirement was dropped from 12% to 10%. It might not ever be dropped again or moved or altered again in your lifetime, and anything's possible, but and this is, we're going to see, this is actually the most powerful tool of monetary policy, this reserve requirement. The next function of the Fed is also very important. It's lending money to banks. All right, and this chapter finishes with a detailed description of what happened during the 2007 financial crisis, and this particular function of the Fed became extremely important and actually expanded in its role of lending money to banks, and we should say lending money to banks and other financial institutions. When the Fed lends money to banks or another financial institution, they do so with what's called the discount rate. So if you hear that term, discount rate, that's the rate of interest that the Federal Reserve charges institutions who borrow money from our nation's central bank, right? So the discount rate. So that's, like I said before, the Federal Reserve is the lender of last resort. And when a financial institution, a bank, needs to borrow money, they borrow at the discount rate. So sometimes you will hear the term discount window again. In other words, a bank or a financial institution had to turn to the Fed to get a loan, and they got it at the discount window. The next function here is a rather mundane function. Is make sure for check collection. You write checks, I write checks, all the checks that are written, to make sure that those checks get from point A to point B, from one bank back to the copy of it, and sent all the way back to the person who wrote the check. A matter of fact, the Fed actually outsources a great deal of this to private companies, but they're still in charge of making sure it gets done. All right, next idea here is also kind of important. The Federal Reserve, our nation's central bank, acts as the fiscal agent for the U.S. government. All right, so if you think about what happens down in Washington, Washington D.C. collects over a trillion, I think it's maybe like 1.3, 1.4 trillion dollars in taxes each year. Right? The government also spends all kinds of money on transfer payments and social capital and defense and such. So our nation, our federal government, the U.S. government, needs a bank to operate just like you need a bank to operate, right? You get your paycheck deposited into the bank, and then you write checks against your paycheck, right? So that's the way the Federal Reserve acts as the fiscal agent for the U.S. government. So every time a check is written by the U.S. government, it's written against their bank account at the Federal Reserve. All right, this next function is also one that's it's important, and it's been scrutinized to a great deal lately, is that our Federal Reserve is mandated to supervise banks within their district, and that is to make sure that these banks are actually functioning in a manner that they are liquid and they are solvent. In other words, they have cash on hand to meet demands of depositors, and they are solvent in that fact that if you look at the relationship between their assets and their liabilities, something we're going to look at a bank's balance sheet in more detail in the near future here, but it's vitally important that the Federal Reserve keeps an eye on banks within its district to make sure they are not taking on too risky of investments. Now, the last idea here is controlling the nation's money supply, and this is the most important function of the Fed. All right, so we will look at the money market in a future set of slides, but the idea here is very simple, right? The Federal Reserve controls the nation's money supply. If the Federal Reserve believes that the economy is sputtering along too slowly, the Federal Reserve can take measures to increase the nation's money supply. And what effect this would have is that increase in the nation's money supply would actually bring down interest rates. Likewise, if the Fed believed that the economy was experiencing too much inflation, the Fed could reduce the nation's money supply to curtail interest rates and therefore putting a damper on spending. We would be remiss if we didn't at least touch on the 2007-2008 financial crisis. There are many causes, and it's actually quite a detailed process on, how we got there, what happened during, and what's transpired after. So this particular part of the chapter will not be something you're quizzed on, but definitely something worth discussing at least for a few minutes here, right? So what happened in 2007 that almost had the world stand on edge and stop spinning, right? So there was a long period of time, it goes actually way back to the Clinton administration, where the federal government encouraged home ownership. All of the rules that had been in place for the better part of 4 or 5 decades, maybe even longer, about lending and mortgages were relaxed in order to draw more people into the home ownership arena. So for the longest period of time, people had to have 20% down payment on for a house, and so they could only borrow 80% of the value of a home. Right? And then the federal government started to develop programs such as FHA loans and these type of programs, which did two things. Number one is that it forced banks, by law actually, to lower lending standards. In other words, to create subprime mortgages, and it actually created a disincentive or we should say a misaligned incentive for people who were renting homes to get into home ownership. And for better or for worse, sometimes people who are renting homes are better off renting homes, because when you buy a house, you're responsible not only for the mortgage payment, but for the taxes and the insurance, and then all of the unexpected repairs that go with home ownership. So, if you're trying to point blame as to what happened, right, that could be the first in sort of a domino effect of why this entire collapse occurred. So banks who were forced into a corner to create loans for not as credit-worthy customers, they responded by creating what was called mortgage-backed securities. So if you can think about the way the typical bank operated for decades, is that they simply loaned out money. So let's assume that they created 10 loans. Each loan was $100,000. So in total, the bank created $1 million worth of loans. And as long as two things happen, number one is that as long as the individuals or the families that the banks lent money to, as long as they repaid the loans, and or the value of the homes backed by the mortgages continued to hold their value or even increase in value, there wasn't a great deal of risk for banks, right? And remember, lending standards were pretty strict. So if the bank lent you $100,000, that means that they believe that the home you owned was worth over $120,000. So if you defaulted, if you stopped paying, the bank simply took over your house, and they weren't in such a bad position because the asset, the home itself, was worth more than what was owed on the home. Now the bank still had to go through the process of cleaning up and selling and such. So they didn't really want to get into that. They're a bank, they're a financial institution. They're not a real estate company. But either way, the banks weren't subjected to a great deal of risk. Then along comes this government program forcing banks into the corner of taking on more risk with subprime mortgages, and banks reacted by thinking of a way, and this is what happens with markets, how can we diversify risk? So they created what was called a mortgage-backed security. Instead of holding on to these mortgages and taking all the risks, banks and other financial institutions, they packaged them together and they sold off mortgages. So individuals, lending institutions, financial institutions, insurance companies, other governments, any institution, any person, any company could buy mortgage-backed securities. So as people paid back their mortgage, if you had bought a piece or all of the mortgage-backed security, you would receive the interest, right? So that was the incentive, right? So this system became even more complicated when they created, credit default swaps, and basically one derivative instrument after another based on the assumption that banks would continue to lend out money, home prices would continue to go up, and individuals by and large would pay back the mortgages, right? So the whole house of cards started collapsing when the value of homes started to come down. People started to default. Obviously most of the people with subprime loans, right? So if you're looking for other blame, like there is a good amount of blame to be held accountable for just good old American citizens who should have been smarter, should have taken a little bit more time to get to know their mortgage and the product they were getting involved with, and should have been more reasonable about what they could actually afford in a home, right? So we can't point all of the blame at the government. Some of the blame should be held accountable for individuals. Likewise, lending institutions were very lax in their standards of how they acquired information as to who actually qualified for loans. So if you think about it, those three parties collectively created the problem. The federal government by creating policies which forced banks to create mortgages for subprime borrowers, and individuals who either knowingly or without much thought or responsibility took on too much debt and went out and bought houses that they couldn't afford. And then of course lending institutions who created loans and gave credit to people who they knew weren't worthy, but they weren't all that, but the lending institution knew that they were going to package it off and sell it away anyway, right? So when the whole thing came collapsing, the federal government and the Federal Reserve had to come to the rescue. So the federal government created what was called TARP, right? Troubled Asset Relief Program. So the federal government actually lent money to AIG, which is an insurance company, and Bank of America and JP Morgan Chase, right? So the federal government lent money to all these financial institutions, and the Federal Reserve bought a lot of those assets, those what sometimes people call toxic assets, right? A lot of those mortgage-backed securities and derivative instruments where there was no previous market, right? So this was good from the standpoint of the combination of the actions taken by the federal government in 2008 by George Bush, and then some more later in 2009 when Barack Obama was elected, right? The combination of those that TARP program probably kept us from traveling over the cliff into the oblivion of economic ruin. Right? Likewise, the Federal Reserve's policy of buying these assets, right, it created a market for these derivative instruments and mortgage-backed securities where there was no market before. Right? The problem with the actions, especially the federal government, is that when the federal government chooses winners versus losers, right, that's called moral hazard. In other words, the federal government decided to save Bear Stearns, but let Lehman Brothers go out of business, right? So why? Like it's typically not the government's decision on which companies or which corporations survive and thrive and which ones fail. The other problem is that if individuals working within these institutions believe that the federal government will always come to the rescue, it creates moral hazard from the idea that they'll take on more risk than they would otherwise, knowing sort of that the government has their back. Right? Now, since then, all types of legislation, some good and some bad, have been passed to try and curtail all of the practices that got us into this mess to begin with. Right? Obviously, lots of people defaulted on their home. Some of them defaulted because they simply couldn't pay their mortgages, and some people walked away from their houses simply because they said, hey, I owe $400,000 on a house that's now valued at $280,000. Right? So if you were what we call underwater, where you owe more on your home than what it's worth, there's no incentive for you to keep paying on your mortgage, right? And that's a shame, because if you think about a neighborhood, if you think about hardworking people in a neighborhood, so there's 50 homes there, and 40 people are going to work every day and struggling and paying their mortgage, and the 10 people decide, hey, I don't want to pay my mortgage because the house is worth less than what I owe, and they don't take responsibility for their actions. When those 10 people abandon their homes, it's going to bring down the home prices for everyone in that neighborhood. Right? So that's a pretty quick synopsis, but a pretty reasonable synopsis of what happened and where we not totally are, but where we're headed since the crisis.